Hello, thank you for joining me in the webinar today. My name is Louis Green. I'm a chartered financial analyst, certified financial planner, certified private wealth advisor. I wrote a book on retirement planning. That book can be downloaded for free at 5stepsToRetirement.com. If you have any questions or want a copy of the book over email, please email me, louis.green@savvyadvisors.com. You can call or text me, 917-590-0552. I'm happy to set up a complimentary consultation. Please feel free to share that information with friends, family, and coworkers. Let's get started. Here's the agenda for the webinar. I'll spend about 25 to 30 minutes presenting. I'll start with a brief introduction to my practice. I'll spend some time on the 5 topics in the book: financial planning, investment planning, tax planning, estate planning, lifestyle management. I'll wrap things up and tell you how to keep in touch. Please note, we do not provide legal or tax advice. Please reach out if you're looking for an accountant or attorney, as we have a network we might be able to share with you. Here's a brief introduction to my practice. My practice sits between financial planning and investment management. I believe that a comprehensive financial plan is the key to managing wealth. I pride myself on being easy to talk to. My approach partitions clients' assets based on their short, medium, and long-term goals to help keep them aligned with their personal financial situation. Growing up, I was inspired by my father, who was an accountant, and seeing the impact he made on his clients' lives. I earned my MBA, and I pursued further education, including the Chartered Financial Analyst, Certified Financial Planner, and Certified Private Wealth Advisor designation. Let's move on to investment planning, balancing risk and return. I am a chartered financial analyst, so I spend a lot of time on investments with our clients, doing our best to create investment portfolios that are suitable for them. Now, here are some of the investment items we consider in our work with our clients, and you should do the same. Start with your investment options. As you can see, there are quite a number of options that might be available to you. There are stocks and bonds. Those are individual investments. There are mutual funds and exchange-traded funds, or ETFs. Those are more diversified vehicles. The exchange-traded funds tend to have lower fees and be a bit more tax efficient. There's separate accounts and direct indexing strategies. Those are strategies in which managers are buying individual stocks or bonds on your behalf. They tend to have higher minimums, but they do offer tax loss harvesting. There are structured products and buffered ETFs. Those are strategies that use derivative investments to attempt to try to reduce risk or enhance returns. Again, there's a lot of risk there, so be mindful of those risks. There are private credit strategies in which managers are buying private debt on your behalf to get you or try to get you enhanced income. Private equity managers are using their expertise to get private equity investments for you, more specialized investments. They tend to be a lot more illiquid than some of these other strategies. There are hedge fund managers that are looking to enhance return, possibly reduce risk, using their special expertise. The fees tend to be higher on those managers, and they also offer less liquidity in some of these other strategies. And there's also real estate strategies. And you can consider any number of these options, but be mindful of the risks, be mindful of liquidity, and certainly be mindful of the managers that you purchase. Consider building a diversified portfolio. So we know in 2024, that was a year in which large cap growth technology companies did especially well, especially a small subset of the market. And it's definitely tempting to put a lot of money in those sectors since they're doing well. But what happens if investment performance changes? We recommend diversified portfolios for our clients. You should consider the same. Monitor your investments. So be mindful of your investments. How much do you have in any one country, any sector? Revisit that on a regular basis. Be mindful of your risk tolerance. I'll share a slide on risk tolerance in a couple of minutes. Be aware of emotional investing and the impact of being out of the markets, even for a few days. I'll share a slide in a couple of minutes. And I'll also share a slide on the efficient frontier, which is a set of portfolios that provide the highest return per level of risk. That's very important as well. And again, we consider all of these items in our work with our clients. Let's move on to risk tolerance. So risk tolerance is essentially the amount of risk you're looking to take in a portfolio. Risk tolerance is very important. We consider in our work with our clients because we want to do our best to keep them invested. Now, your risk tolerance is a function of two things: your ability to tolerate risk, and that's really going to be determined by your time horizon, the amount of income that you need from the portfolio, maybe the amount of cash you need from the portfolio, and then your willingness. That's more of your psychological makeup. So those two functions make up your risk tolerance. Be mindful of your risk tolerance, and we consider this in our work with our clients because we want to keep them invested in a portfolio that's suitable for them. Speaking of risk tolerance, here's a set amount of portfolios. We're looking at returns from 1926 to 2022. There's 11 portfolios ranging from the most conservative on the left side, that green, where it says 100% bonds, 0% stocks, to the most aggressive on the right, 0% bonds, 100% stocks. And let's look at an example, that 60-40 portfolio. That number in the middle, that's 7.6%. That's the average return over that time period. Now, your portfolio is not going to mimic this exactly. This is a portfolio that's using market indices, so be mindful of that. But you can look, you can see here, the highest return for 1 year for that portfolio is 27.9%, but the lowest return was 18.4%. So be mindful of these numbers as you construct your portfolio, or maybe when you're looking at your portfolio as well. And we do the same in our work with our clients. Be mindful of the efficient frontier. The efficient frontier is a set of portfolios that provide the highest projected return per level of risk. And let's take a look at an example here. This is a sample client, not a real client. The client's current portfolio is represented by that red plus. That current projected risk is 13.35%, and that standard deviation is the definition of risk here. The projected return is 6.08%. Well, there might be a way to tweak this portfolio to reduce the risk to 9.63% and increase the return to 6.75% and get the portfolio to the efficient frontier. That's represented by that green diamond. Now, many portfolios might not be able to make that switch because of things such as capital gains, but you should at least be mindful of the efficient frontier. We work with our clients. We really do our best to get their portfolios on the efficient frontier. Emotional investing. This is a very powerful chart. This is one of the reasons why we recommend clients stay invested and why we do our best to construct a portfolio that's going to keep them invested. Now, this is the S&P 500 over the past 25 years. You can see here, if you look at the top of that chart, the total return per year is 7.67%. Well, if you missed 10 of the best days and you were invested in this index, wouldn't have been possible for the most part, probably. But your projected return would be reduced to 4.36%. And what does that do to you or do for you? Well, look at those ending portfolio values. Fully invested, the portfolio ends up with a value of $634,000. Missing the 10 best days produces a portfolio that has an ending value of a little over $290,000. It's a very powerful figure. As you can see here, it really makes a big difference. So be mindful of this and do your best to stay invested. Market timing is difficult, if not impossible. And we do our best to produce goals-based portfolios for our clients. It's going to keep them invested. That's the end of the presentation. As I mentioned earlier, please feel free to reach out to me if you have any questions. You can email me at lewis.green@savvyadvisors.com. You can call or text me at 917-590-0552 if you'd like a copy of the book. Go ahead and navigate to 5stepstoretirement.com/ebook or email me for a copy of the book. Thank you for attending the webinar. I hope everyone has a great day.